Reducing balance method. Reducing balance method is the second common method that we use to depreciate PPEs. Reducing balance method. Now, the reducing balance method is also known as the declining balance method. And this method allocates a high amount of depreciation expense in the early years of an asset's life and a lower amount in the later years. And it is calculated as net book value times the depreciation rate. We apply the depreciation rate on the net book value. Here, depreciation charge is equal to the net book value times the depreciation rate. Is that simple? We apply the depreciation rate on the reduced balance. But in the straight line method, we apply the depreciation rate on the cost constantly throughout the year. We apply it on the cost. It is constant. But here it's applied on the reduced balance. The net book value is the reduced value. It is the written down value. And we calculated by deducting the accumulated depreciation from the cost to get the net book value, the reduced value. So each year it keeps on reducing, such that in the earlier years, on the early years of an asset, the depreciation is higher as compared to the other years. The initial years, the depreciation is higher. So let's have an illustration. A business buys a plant for 10 million shillings. The business estimates that the asset will be used for 5 years. The plant is depreciated at 40% per annum using reduced balance method. We are required, Roman 1, to write up the plant account. Roman 2, provision to depreciation. Roman 3, we can adjust that. There is no disposal. Roman 3 is a profit and loss account. Extracts. Roman 4, balance sheet extracts. So you can delete disposal. We've not yet reached there. So before we compute before we write the plant account, we need to first calculate the depreciation for each year. That is a working. We need to make that working. The working depreciation charge for each year. What will be the depreciation charge for each year? Illustration. So the depreciation in year 1. So the asset was bought, we are told the asset the years are not given, but we are told it's 5 years. The asset be in use for 5 years. Okay, you just say year 1, year 2, year 3. Depreciation in year 1 will be equal to the cost, the initial cost of let's just begin with the cost. The cost here is 10 million. That is the cost. So depreciation year 1 will be the cost times the rate. In first year, we don't have a net book value in year 1. We have the cost. So the depreciation will be with the rate, multiply the rate of 40% times 10 million. This is the depreciation for year 1. 40% of 10 million. Is it 4 million? Does it make sense, that percent? Forty percent of 10 million. George, how much is it? Let's work with the figures right there. Just 4 million. 4 million. So deduct 4 million from the 10 million. So we have 6 million. This is the net book value. So depreciation year 2 will be 40 million times the 6 million. How much is that? Is it 2.4? Is it 2.4 million? Is it 2.4 million? Deduct it from 6 million. Is it 3.6 million? This is the net book value. So depreciation year 3 will be the 40% times the net book value of 3.6 million. How much is it? 40% of 3.6. 40% of 3.6. %40 of 3.6. George? $14.40 deducted from 3.6. This is 60.1. So that is the net book value year 3. This is 40% of 3.6. Someone says 2160, which is which? 2160. This is 2160. So that is the net book value. Then depreciation year 4 is 40% of 2160. How much is it? 840. Is that true? How can it be 840? Should be reducing. Should be reducing 40% of 2160. Supposed to be less than that, George. 864. 864. So what will be the net book value? Net book value 1296. Like that. So year depreciation year 5, 40% times 1296. $518,400. What do you mean 518,400? It's 518.4. That's what you mean? So when we deduct, what is the net book value at the end of year 5? So what is the net book value at the end of year 5? 1296 minus 518.4, 777.6. So you can see, candidates, the depreciation for the year. This is the depreciation for the year 1. So it is higher than depreciation for year 2. The depreciation for year 2 is higher for depreciation in year 3. This is year 3. Year 4, depreciation keeps on reducing. In year 5, it has reduced. Then the book value is 777,600. And the company estimated that the business estimates that the asset will be used for 5 years. Now, if it will be used for 5 years, and the net book value is 777,600, that tells you that this is the scrap value. The asset will not be in use after 5 years. So the business can sell this asset at this amount. So that is how to calculate depreciation using the reducing balance method. The depreciation rate is applied on the reduced balance, the diminishing balance. That's why we are calling it reducing balance method. Is that clear, George, and the rest of you? So the next requirement we have to prepare is a plant account. Plant account. We're going to open a plant account. This is a plant account. It's an asset account. So we have year 1. The cost, it was bought in year 1. Are we told the dates? We have the dates. We are assuming it is on 1st because we are not told it is July or August. A business buys a plant on that day. Let's assume it was on 1st. So that is on January 1. Year 1, January 1, bank. The amount is 10 million. Then December 31, balance carried down is 10 million. So we close this account. So there is no any transaction affecting this account. So the balance at the end, bring it down in year 2 as balance brought down 10 million. We close this account. December 31, that is year 2, balance carried down 10 million. Again, we close this account. We close that account. Balance at the end in year 1, bring it down in year, that is year 2, bring it down in year 3 as balance brought down 10 million. Towards the end of the period, December 31, balance carried down 10 million. Close that account. Close it. Balance carried down at the end of year 3 becomes balance brought down in year 4. Balance brought down 10 million. Towards the end, balance 31st, balance carried down 10 million. Close the account. Close the account. That is year 4. There are 5 years. Year 5, balance carried down 10 million. December 31, balance carried down 10 million. Close it. Close it at that. That's how to prepare a PPE account. It is always maintained at cost. Always maintained at cost. Always maintained at cost. If there is any disposal, then the asset account is credited again with the cost of the asset that is being disposed. If there is a new plant that is being bought, we will debit this account at the cost of the new plant. That's how we account for PPE in the PPE account. Then we have to do provision for depreciation. Provision for depreciation account. It's Roman 1, Roman 2. Provision for depreciation of plant account. Provision for depreciation. This is an account that gives us the accumulated depreciation. So, year 1, depreciation charge for year 1 is 4 million. So we'll come to this account and record on the credit side. This is year 1. Year 1, December 31, profit and loss, 4 million. We'll take to the profit and loss account, 4 million. So we are going to have a corresponding entry in the profit and loss account of 4 million. Then the same date, year 1, December 31, the balance on this account is 4 million. So we'll close that account. That is year 1. In year 2, January 1, the balance brought down. This balance carried down at the end here. We bring it down on the credit side, 4 million. That is year 2 at the beginning. Now year 2 at the end, we have December 31. We charge again the depreciation for year 2, which we calculated here. The depreciation for year 2 is 2.4 million. So we come here and write 2.4 million. And we close that account. That will be 6.4 million. Close it. So towards the end, this is December 31, balance carried down. The total balance carried down here is this total, 6.4 million. So we come here and close 6.4 million, close it. Are you following? Are you following? So this balance in year 1, this is year 2. We bring it down to year 3, January 1, balance brought down. The amount here is this balance, 6.4 million. December 31, profit and loss. In December in December year 3, what is the depreciation? Year 3 depreciation, 1440. It's 1440. So this 1440, the total is going to be the accumulated depreciation, 1440. So here we have 40. Is it 8 and 7? So we have year 3, December 31, balance carried down. The total there is 7840. So we come here and aggregate 7840, close that account. That is the 3rd year. In the 4th year, year 4, balance brought down. Year 4 is a 7840. 7840. December 31, profit and loss. The depreciation charge in year 4, 864. This is 864. So we add 864 here to the 7840. This is 0472. Please confirm. That is accumulated depreciation December 31. Balance carried down 2704. This we close it, bring down the balance. Year 5, balance brought down 2704. Depreciation charge December 31. Depreciation charge in year 5, December 31. How much is it? December 31, depreciation charge is 518.4. 518.4. Give me this total. 2704 plus 518. Someone says it's 8704. 8704. 8704. Which one? 87. This one. 8704. 8704. What is the accumulated depreciation? December 31 balance carried down. Balance carried down. This is 8704 plus 518.4. What is the total? Karuki? I'm waiting for the total. 8704 plus 518.4. 9222.4. This is 9222.4 is the accumulated depreciation. So this will close at 9222.4. Again, we close it there. You understand? Now that's why you see candidates. The cost of this plant in year 1 is 10 million. At the end, you see it's 10 million. And given that there were no additions or disposals, this 10 million, this plant account, the cost is constant throughout the 5 years. It's 10 million, 10 million, 10 million year 5, 10 million year 5. Then we calculated the provision for depreciation account. This account helps us to identify or to know how much is charged for depreciation for each year. And you can see in year 1, the amount that was debited in the profit and loss account is shown there. It's 4 million in year 1. You see that? 4 million in year 1. In year 2, it's 2.4 million. In year 3, P&L, this is 1440. In year 4, P&L, 864. Last year, P&L, this is December P&L, it's 518,400. 518,400, and it's the same amount we calculated in our working for determining the depreciation using the reducing balance method. This is the depreciation for year 1. Can you see this? The same amount there. Year 1. In year 2, depreciation in year 2 is 2.4. Depreciation charge for year 3 is 1440. Depreciation charge for year 4 is 864. Depreciation charge year 5 is 518,400. That's how to calculate depreciation. And these are the amounts that will appear in the profit and loss account, on the debit side of the profit and loss account. Now, when preparing the balance sheet candidates, subsequent measurement of PPE, we say that PPE is generally measured at cost, less its accumulated profit. I mean, depreciation, we say that the subsequent measurement of PPE, the PPE is generally measured at its cost less accumulated depreciation. So, for example, in the first year, the value for the plant will be the cost At the end here, we deduct the accumulated depreciation in year 1, which is 4 million. The difference will be the value of the plant in the balance sheet. In year 2, we'll take the cost that is shown there as a balance in the PPE account. We come to the provision for depreciation and check what is the accumulated depreciation. This is the accumulated depreciation at the same date, For year 3, this is accumulated depreciation. For year 4, this is the accumulated depreciation. For year 5, this is the accumulated depreciation. So that's how we prepare the subsequent. Well, that's how we measure the PPE subsequently. No, Tino does not have a question, and I don't see anyone asking questions. So I will be sending revision questions on depreciation in the group. Please make sure you attempt the question. We will also be communicating when we'll be meeting. Please keep in touch. If you have questions, please feel free to send the questions. And as we are doing the topic on accounting for assets and liabilities, what we are learning here will also be helping us as we prepare the financial statements for sole, for company, for partnership, for manufacturing, and for non-profit making organizations. Because in all those statements, we are required to make sometimes adjustments to the, for example, the expense on depreciation. Bye-bye.